There's like, good morning. Okay, guys, it's 9 o'clock. The door is closed. Class has officially begun. I'll be like that high school teacher that says, "I'll wait." So great. Hope you're all well. It's incredible. We're at the 6th week already. It's really flying by. A couple of small housekeeping things. Number one, we may or may not have a speaker today. I was extremely excited to get the new CEO of Bio. Bio is the Biotechnology Industry Organization, which is the umbrella political group for all of the biotech industry. And the first year that I did the course, I just kind of a wing and a prayer sent an email to the then CEO of Bio, who I said, "Listen, we're doing this course in entrepreneurship biotechnology. Love to have you as a speaker." And he said, "Sure." So took the Acela up from Washington, sat in. It was actually in this building, had a great chat. And back in, I think it was January or so, a new CEO of Bio, he stepped down, a new CEO was named, and she's just unbelievably impressive. So I figured, what the hell? So I sent her like a little Twitter note. I say, your predecessor spoke in my class. Love to have you. And she said, "Oh, terrific. Love to do it." So, the power of social media, even for us of a generation where we don't think so. And problem was, the communications got kind of mixed up. So all the speakers, I send them all reminders and stuff. I've got a long email about how it works. And I never heard back from them. And then finally, at last resort, I sent her another direct message through Twitter. And she said, oh yeah, I'd love to do it. Sure, what happened? And I said, well, yeah, so anyway, so she gave me somebody else to reach out to, which I did. And I got a cryptic email a few days ago, said, well, this is great. We're going to see if we can get Dr. McMurray to free up the time. And I've heard nothing since. So at 10 o'clock, or maybe some other time, she may just show up on the Twitter feed, in which case I will be more than happy to hand the class over to her. She is a fascinating background. And just to talk about her, and maybe if we have time to talk about what bio does. But it's anyway, so we may or may not have a speaker. I am prepared to try to keep you all entertained for that second hour, if indeed we don't. So just today we'll have a little bit of a shaggy dog aspect to it. So what I want to do is I want to go into covering some of the topics for today, lecture-wise, and we will see how it goes. We may or may not do some pitches today. I know a couple of you have asked me to pitch. I would ask if you've asked to pitch, but you've pitched already, I may defer you a little bit. Okay, and again, the pitching is not something I'm grading you on. It's something as we're using the experience and your reaction to it and the way I ask you questions as a learning thing. So don't feel that I'm unprepared, over-prepared, anything of that sort. I will also ask if a few of you have reached out and asked if you could pitch to me privately or do the pitch. Maybe if we get to the end of the class and there's stuff we haven't gotten to, but the whole purpose of the pitching is to do it as a group so that everybody learns from each experience. That'd be great. Another little issue, and this is almost so trivial that it's not worth mentioning, but I mention it anyway. A few of you have asked to connect with me on LinkedIn, which I have zero objection to. I think that's fine, but I'm very conscious of professor-student, channels and things of that sort. So happy to do that once the course is over. And actually, a lot of my ex-students are still in touch with me for various reasons, and I'm happy to do that. My own feeling about teaching this class is once you've taken the class, you're part of the family. So, 5 years later, for whatever reason, you think that I could be helpful for something, feel free to reach out. It's unless Columbia revokes my email address or something, which you never know. You can reach out that way. If not, I don't know, maybe on Twitter or whatever. So let's leave it at that. A couple interesting things happened over the week. I don't know if you've been following the vaccine booster issue and just seeing how things are meandering through, taking the raw data out there. We talked before about how pandemic data is by nature suboptimal because it's real time. We have a real current problem we're trying to deal with. So you're seeing the CDC and the NIH and the FDA trying to balance putting good data to work right away with not cutting too many corners. And it's kind of a thankless job, and they're leaving themselves open to criticism from all sides, which they get no matter what, because they're a political agency, but they're all grown-ups, adults, they realize they signed up for that. It's made that much more difficult by the current ongoing nature of it. So for example, the testimony that went on this week relied a lot on data from Israel, because essentially the Israeli government and Pfizer struck an agreement early to do a full court press on heavy vaccination in enormous parts of the population. And like many countries, like many small countries, Israel has a very good system of keeping track of medical records. So typically the FDA would not be relying on another country's data so heavily, but they're doing it here. And the way that, say, the Pfizer vaccine booster data was looked at, and then this past week, the Moderna vaccine, even though the difference in data was enormous, yet the kind of willingness to extrapolate from one vaccine to another in a limited way is something you would never see for normal routine approval decisions. It's like one company's checkpoint inhibitor versus another company's checkpoint inhibitor. There's no way that they're going to let company B cite company's A's data for any type of approvals. That was very interesting. Interesting stuff too. We've dug in a little bit. Certainly when we were doing our biopharma case studies a week or two ago, we started talking about DNA-based therapeutics, gene therapy leading to gene modification, gene editing leading to single base editing. That's coalescing with some of the more advanced cell therapies we've been seeing lately. The CAR T type therapies where we essentially rev up your body's own T cells. Remember, the human immune system is one of the most advanced, powerful, and complex systems in the entire universe. So we might as well take advantage of it. At the same time, we've got to realize that this is not a place we're going to go for simple answers. So the initial CAR Ts have been fabulous in efficacy for some extremely difficult cancers, for example. On the same hand, they evoke these out of control immune responses that have, so frankly, the treatment sometimes kills the patient as well. So we're now applying real specific gene modification, gene editing to these types of cell therapies in an attempt to improve our therapeutic index, improve the good and decrease the bad. And there are a couple of companies that released some information over the past week. So it's not a bad thing to follow. I've given you names of several podcasts that are really good ways of keeping track of all this stuff. Thursday afternoon, Stat News puts out the Readout Loud. There's something that they call the Readout, which is their biotech coverage. The Readout Loud is the podcast. And they covered all this stuff this past week. And it's just like a recap of 25 minutes. And not parenthetically, all three of the people on that podcast have been speakers in this class. It's like I kind of caught them in their early, less famous days. But it's a really good thing to keep track of. And they're kind of entertaining as well. They hit the political aspect, they hit the science, very, very high level stuff. And in any given week, they may have the FDA commissioner on, they may have Scott Gottlieb on, who just wrote a really terrific book about the COVID pandemic. So anyway, good stuff there. So I'd like to dive in, and then we can, depending on how much time we have later, may get to your questions, may do some pitching. Let's see where we go. This is week 6, and I want to finally hit the funding cycle. Now, if you recall, this lovely slide, and one of the problems with my Mac at home, I can blow things up and make them big. And with Windows, either I'm too dumb to figure out how to do it, or Windows is too dumb to let me do it. But recall, this is our template for early stage entrepreneurship. So we've spent a lot of time up here in the identity and communications arm. Remember our 4 arms. And we talked about business forums, partnerships, and 501c3s, and difference between a corporation and an S Corp and a C Corp and an LLC. You've all heard LLC. That's what when people talk about shadow corporations and things like that, they mean LLCs. LLC is actually much more innocent. By the way, it's an exam. If I have a final exam, there will be a question said true, false, LLC stands for Limited Liability Corporation. And the answer is false. It's limited liability company. An LLC is actually not a corporation, even though it has many of the same characteristics of a corporation. So if anyone's not here today, don't tell them. You'll all get the question right. They will get the question wrong. But it's something that it's a common mistake that's made. So that's the arm we've spent most of our time on. We're going to be spending a lot of time on proof of concept. Actually, our second hour today is going to be devoted to that if Dr. McMurray Heath doesn't make it today and we have to defer to another time. Remember, our third arm is protecting what's proprietary. And remember, these are things that you're thinking of in parallel. These are your 4 arms of your early stage company. And every day you're going to run through your checklist in your mind. Okay, what am I doing on my pitch? What am I doing on setting up the company legally? How am I working on proof of concept? What's going on with funding and what's going on with IP? And IP is usually, certainly in something like biotech, it's almost synonymous with a patent strategy. There are other fields where patents are not as important. Maybe trade secrets, it may just be operations, maybe first mover status, maybe the fact that your strategy is continually evolving to stay 1 or 2 steps ahead of competition. And then where the area we're going to focus most on today is funding strategy. Now, what I want to do before we zero in on funding a biotech company is let's think about companies and enterprises in general. Because your strategy for funding is going to fall out of kind of the nature of the business you're setting up. Because from the time 0, when the business exists, there will be a time when the company itself is self-funding if it's going to be successful. A business cannot continue to lose money forever, although there are an awful lot of businesses that seem to. And the accounting system actually sometimes makes it easy to make it seem as if the company's losing money. That's why Amazon gets away without paying taxes, because accounting lets them. But in general, you reach a point where which you call cash flow positive, meaning the money coming in exceeds the money going out. That could be really quick, or it could be very, very, very long. And the nature of that interval is what defines what your funding strategy is going to be. That seems very obvious, but it's something that helps you put into context. If you're looking at a biotech or an exploration company, it'll be pretty obvious. If you're thinking about something in the middle, you have to kind of think, okay, where are we going to get the money for this? How much do we need? And what are the normal sources? The great thing about biotech is because the length of time to cash flow positive is so long that it's a good reason to teach all of the different ways of funding. But you think about it, with a service business, simple service business, you're gonna tutor, you're gonna teach violin. Years ago, before we stopped printing things, there were printing businesses. You buy a printer, you get a little storefront on Broadway. People would bring in first floppy drives, and then thumb drives, and then they email the PDF, and they print it on paper. You'd come in, you'd pay 50 cents a page or whatever, and that would be that. Service businesses in general, unless they require a tremendous amount of capital equipment up front, which most of them don't, unless you're doing something like heavy digging, if you're digging basements, you got to buy your tractor up front. But even there, you could probably finance. Cash flow positive happens pretty quick. Now, moving down the line of different types of businesses, like franchises, for example. If you want to own a Starbucks, or you want to own a Joe and the Juice or something like that, you go to and they franchise this. There is a kit and a plan and a financing ability, and they know just how long it takes before you start making money. And it's a pretty straightforward process, very transparent. Someone's thought it through in advance. If you're going to start a business and franchise it, the value of the franchise in large part comes from your ability to precisely define the cash flows of the business. So that when somebody walks in who says, okay, I'm bringing a hard work ethic, reasonable operations ability, put me to work, let me buy into your franchise. You can put rational pricing and a rational funding strategy on this. And it's a way of letting a business scale without having, let's say, you got Joe and the juice. Let's say, Jill, this mythical Jill wants to replicate that business from scratch. She has to learn it all. She has to learn all the hard stuff up front. So her time to cash flow positive, which in turn will define what her funding possibilities are, is way off. So she's not going to just open up a storefront next to the one that's there and be able to be competitive right away because the other businesses already run their stuff. What is software? Software is one of the great businesses because the cost of development really comes down to the cost of smart coding talent, which is not cheap, but you don't have to buy a lot of stuff. It's like show up with your laptop, it's sign a exclusivity agreement, put in some security and start coding. It's like, which I don't mean to trivialize it. I could not order lunch by coding, but it's something that's a defined skill. There's a defined population of people who do it well. You set some of them loose on a problem and the work is fabulous. Once the work is there, cost of distribution for software are really pretty minimal. And the incremental cost of producing each additional software is trivial, it's infinitesimal. So, the old days, we talked about EdTech software before. The old days, you had to print it out on floppy disks and box it up and shrink wrap the boxes and get them out to retail and advertise and things of that sort. Nowadays, you go to the App Store, you just download it. It costs you virtually nothing. So once the product is developed, which depending on the complexity of the product can be months to a year or more, once that happens, you can get to cash flow positive if there's demand for it pretty quick. So that's a good thing. Now, when you start getting into the world of tangible stuff, where you've got to go to a certain place and make something that you can hold in your hands using equipment or trained labor, then the cost of running your business up front or building your business before you start making money starts getting longer. So light manufacturing to heavy manufacturing, if you're building rocket ships, if you're building, tractors that run on electricity, something really new, you've got to build out your manufacturing. You got to make sure it works. You got to train people. You've got to get specialized equipment. You've got to build out factories. You need to find a way to get stuff, big chunks of steel into your factory, and you've got to ship big things out of it. A lot of costs up front before day one of making money. So there's a whole spectrum of complexity of manufacturing, some of which may put the time before you make money off quite a ways, requiring lots of different levels of financing. Remember we talked about earlier about trying, that one codicil of finance to try to match up the length of the financing vehicle with the length of the asset that you're putting into your company. There may be things you want to buy for cash. There may be things that you want to lease for certain periods of time. You want to take long-term mortgages out. You may have to take out a mortgage for build-out costs for the facility. So lots of complexity to the financing plan. And then finally, you reach those types of businesses like biotech, that because of long R&D schedules, heavy regulation that have, in many cases, a decade or more for product development, which in turn dictates an enormously long and complex funding strategy. So when you think about biotech, you start hearing very quickly about venture capitalists and going public and cap tables and you go from science to business really, really quickly. So what makes biotech so hard is a multifaceted answer. The number one is financing it. It has nothing to do with the complexity of the science you're dealing with. And one of the reasons courses like this exist is to take people that have a core competence, very, very deep, very, very broad in the language of basic science, and kind of give them this kind of concurrent vocabulary to let them follow along, and to the extent they can, control how to fund, how to take that basic science, make it an applied science, and make that applied science into a business. Because one way or the other, you got to pay for the stuff along the way. So funding is a big part of it. A biotech company is really two companies in one. It's a science to product company. Idea to tangible benefit to the people that you affect in a positive way. So you take an idea and you make it into medicine, or you take an idea and you turn it into a process. It may be a manufacturing process, it may be a synthetic bio process, it may be an agricultural process. But it's a lengthy intellectual to tangible product interval. And we're going to focus on the toughest part, which is therapeutics, i.e. drugs. So you've got a long development cycle. And this has to be plugged into that proof of concept part that we were talking about. How do you fund something that's not making money for long periods of time? How do you attract risk capital to a process where we don't have the luxury of working with numbers, with dollars? How does Warren Buffett make decisions on where to put Berkshire Hathaway's money? It goes through that lottery. The company brings in a certain amount of cash each year. Here's what we project the growth to be. Here's what we project maybe what efficiencies can give us. And how much is that projection of cash flow for the future worth now? It's not a simple equation, but it's a fairly straightforward concept. It's cash to cash, future cash to present cash. How much am I willing to pay for the later cash with discounted for the risks, things that change? How much do I do it now? That's the basis for so much of the financial world. It's kind of that, the $1,000 in your mailbox a week for life versus a single payout right now. If you understand that concept, you understand the basis of finance for cash generating businesses. As we step away, as we make it less a lottery ticket backed up by the US government or a state government, i.e. something that's low risk, to something that's greater and greater risk, marketplace risk, product development risk, competition risk, interest rate risk, inflation risk, then our ability to accurately come up with a valuation gets lower. But we're still talking math. We're still talking dollars to dollars. When we go into something like forming a biotech company, where the first dollar may not show up for 10 years coming in, and you've got in between now and then, you've got idea to earliest experiments. And these may be cell culture experiments, something in a petri dish, figuratively speaking. And then you've got an accelerated series of preclinical animal experiments as we start tackling the unknowns of complex biological systems. Even as simple as mice are. Mice are pretty complicated. Much of you know that, having done mouse experiments. And then you reach that big chasm from preclinical to clinical development. You go into human trials, and suddenly we're working with the human system, one of such incredible complexity that it's the battlefield of drug development is strewn with the carcasses of unbelievably smart people trained in science who just found that once the molecule that seemed so perfect, either in preclinical work or in silico work, it reaches the battlefield of the human body, and it just doesn't do what we think it's going to do. Because what we don't know about what happens to the body still in 2021 dwarfs what we actually do know. So you've got all this uncertainty. How do you fund it? Well, you've got to fund it by designing a development path that rewards the investors at each step of the way with a pretty well definable time frame for when you have what we call value inflections. Okay, the idea seems good, the molecule looks like it should work. And then let's go and manufacture. Let's do a run to show we can make it. Okay, that's a bit of value inflection. Okay, let's shoot into mice, make sure we don't kill any of them. And let's do it in different doses to see if we've got a nice therapeutic range that we can work in. Let's see if it does what we think it's going to do in terms of being excreted either the GI tract or by the urinary tract. Let's characterize it in a way that seems to be, that gives us confidence we can predict what it's going to do. And now let's go to the efficacy side. And let's use known models for different disease processes, maybe specific, maybe broad. In the beginning, you may just start with basic models of undifferentiated growth for cancer. They may be basic models for inflammation, for immunology. And let's see how well it works there. And then you start comparing the stuff that you generate and you infer from your basic experiments to stuff that we know works, stuff that we can use as reference points. You start going out to knowledgeable people and they will start paying you for a piece of your project. And that the form of that payment will vary, as well as the amount of the payment, based on how exciting it is, how smart they are at recognizing how exciting it is, and how long it's going to take to make it to something tangible. So you've got to put together a proof of concept or a chain of proofs of concept so that you come to me and say, I'm doing this. I'll sell you 10% of my company for X. And I know full well, or you're going to tell me full well, how far that money's going to last. They say, so the first thing you say is, what are the use of proceeds? That's the term we always use. What's the use of proceeds for this fund? So, well, we're going to do this series of experiments. What are the experiments going to tell you? And when you go out and you come back to me.
Okay. I found this on the web for what's the use of proceeds.
Thank you, sir. Didn't have that in 2011. Anyway, so you're going to go back out to your investor group and you say, okay, what's the, I want to raise money again. First question is I ask myself is, do I want to invest now or do I just want to wait till then? Because if it's not a convincing value inflection, then I'm going to say, well, hell, I'll just wait till later. Because it may be that you're going to go out and raise money for the same amount you're doing now. There's no reason for me to invest now. Or I may look at it and say, there's no way in hell that's going to work. I'll say, forget it. Or hopefully you've come up with a very convincing thing to draw me in, and then we negotiate. And you say, okay, I want to sell you 10% of my company for X. And I say, well, I'll pay you half of X for 10% of your company. Or I want that, and I want an option to buy even more. Or, as we talked about earlier in the course, I may not want to put down a value on it. I may want to be able to ride the optionality and just have an option to buy or to convert what I've given you into whatever a later round is, but with a discount. Because neither you nor I can accurately assess a real value and evaluation on what it is you're doing for now. So let's just say, okay, I'm going to give you a couple $1 million. It's going to last you a year, and then you're going to go out and you're going to need to raise $10 million. You're going to raise it from a group of really knowledgeable investors, and and they will negotiate a valuation. I may be one of them. I may be negotiating with them. And then, okay, we're going to put a value on that company a year from now. The $1 million I gave you now, or the $2 million I gave you now, that's going to convert into ownership then, but at a 20% discount to what everybody else is paying. This way I get paid for taking the risk earlier. I get a reward for that. And it's just the nature of a lot of these early rounds. Sometimes there'll be a series of these early type rounds where we don't put a real hard valuation on there. Okay. Now, this is a kind of a simplified schematic of what goes on in the business side. Again, you're running two businesses. You got a science business and a finance business. This is your science business. And you start off with basic research. I'm going to use a little nifty pointer here. Start off with basic research that may be done here. It may be done elsewhere. You may in-license it. You may have done this work yourself. You may have done collaboratively. You may have just noticed a publication and decided to work with the people that published it. And then you start getting tangible. In the drug world, you want to find targets. You want to find specific molecules, but more importantly, you may have a library of molecules that's out there, and you've got a new target to aim at. So, okay, we've got a target. Let's validate the target. Let's do a series of experiments that show the agent I'm working with, A, is identified and shakes hands with the target, and then B, makes something happen biologically that we can exploit for some type of benefit. It's very non-specific stuff. Then you may have a family of molecules you're working on once you've got the target, and you're going to throw a bunch of things at this target and see what has the best parameters. Which one focuses and has which one focuses on that target with a laser rather than having a shotgun hitting lots of different other targets and maybe giving you off-target effects that you don't want. From there, you've all heard the terms lead identification, lead optimization. From all the agents you're looking at, you figure out, okay, this is our best candidate. You do what you can to make it from a raw molecule to a druggable molecule, something that you can put into a living system and make sure it works, doesn't harm them. And particularly one that you can put into a human being with a likelihood that the dose that you think you need to have anything happen can get to the organ that you need to get to. So if you're working in the eye, for example, the transport is much simpler than if you're working in the middle of the cerebral cortex, or if you're working in the level of the heart. Remember, we talked earlier in the course about the stratification of the body's protections. The CNS being the most carefully protected part of human anatomy, the cardiovascular system and the skeletal system shortly behind that. These are absolutely sterile systems. These are the groups that when you operate on them as a surgeon, you're operating in a laminar flow operating to minimize the risk of infection. You do not want to deal with a infection of the bone if you're an orthopedic surgeon. You certainly don't want to deal with an infection of the brain, an infection of the heart if you're operating there. You've got other areas of the body, it's easy. The eye is extremely easy to get to. It's one of the areas why gene therapy has been focused in large part disproportionately on gene therapies that work at the level of the eye, because it's easy to get in there. So you go through all this and you say, okay, eureka, we've got something that quote unquote looks like it could be a drug. So at each one of these steps, your project is worth more. And you should, in theory, if you're convincing enough, and the people you're talking to are conversant enough, be able to raise money for it to fund the next thing. Of course, you've got to define the step after that to aim at an even higher increment. So you've got to, it's a stepwise process. Every step has to be up, because each of the things you do along this path is more and more expensive. There's a group of things you can do by yourself or with a tech in the beginning. There are things that you get towards the end. You need not only science ability, you need the applied science ability, you need the you need epidemiology, you need biostatistics, you need regulatory, you need lots of things to shepherd this project through. Not to mention, mice are more expensive than petri dishes. Working on humans is more expensive than working on mice. You may get primates in there. So it's very, very quickly gets real expensive. So this is your science side. Now, this stuff does not necessarily all happen in your company. You may find that the early basic research may come out of academia. You may find that the early stuff comes out of the shop that just does early target identification. There are companies that do that. Some of the work itself, as you go through these steps here, can be done. You can contract. There are contract research organizations that do this. There are those that focus on preclinical work. There are those that have specific specialties, depending on the type of work and type of cells and type of animals. And then, there's an enormous industry of contract research doing clinical trials. Or you may decide and have sufficient funding to do it all yourselves. And somewhere along the way, too, you may decide to share your project in an operational way with a much bigger company that's deep pocketed. So this is half of your company. This is the business end of your company. Oh, probably the wrong term. This is the fundamental side of your company, the thing that makes it a biotech company. In the meantime, you're essentially operating a small bank in order to fund this stuff. And the ability of your company to succeed in a large part comes from the ability to match up, properly funding each step of the way, so you're not giving too much of the company away, or you don't run out of money somewhere in the middle of the step. Because what happens there is, if it's great work, it's going to end up somewhere else. So you may find that the work you did is something that you ran away from because you probably for a lot of good reasons, you just guessed wrong how much money you needed at a certain time, or the conditions of the market were not conducive to raising how much you need. So what are the various steps? And this is fairly inclusive of just about everything. You start out with seed capital. Seed capital can take a lot of different forms. The earliest is always something that you fund yourself. At some point, you got to open up your checkbook or max out your credit cards and do something and put a little of your own financial skin in it. Now, most of your input into the company is going to be through your knowledge, your time, the sweat equity that you put in from the very, very beginning, whether it's by triaging time away from time you could be working doing something else and earning money, or whether you actually need to go to an incubator and rent a lab bench, or trade some amount of tech work for the ability to use a professor's laboratory at night, something like that. You can be very creative. But that's your seed funding. There's also seed rounds of venture capital. There are people that will, depending on the size of your seed capital raise, and if you have a name out there in the marketplace, or you've got affiliations where you know enough people, or you're working in an area that's really highly valued, you may be able to tap into professional investors extremely early and raise in the millions of dollars, rather than starting off humbly with the tens of thousands or hundreds of thousands. The seed capital can take a lot of forms. Those forms, I put crowdfunding in here. This is an old slide. For a while, a lot of people were playing around with crowdfunding. It seems to become a little less popular. My own feeling is that's a good thing, because crowdfunding, unless it's targeted with people with extreme domain knowledge, can be very exploitative. You say, okay, I'm going after a treatment for ALS, and you put pictures of people suffering, you go on a crowdfunding site, and you come up with a very convincing means to raise money for a tremendously good cause. The problem is the people you're raising money for, there's very little vetting of them. And they could be, it's like we've got the Securities Exchange Commission that protects individual investors. I don't know that the same type of protections are there for someone whose heartstrings are pulled on and ends up giving money in a very inefficient way, or even a fraudulent way. So seed capital is, it could be your own, it could be friends and family. And friends and family sounds kind of cliched and trivial. It's not. There are tremendous projects that got off the ground because your family is willing to back you, they're knowledgeable enough, or they just love you and they want to back you, which is fine. Similar acquaintances you have. This can be very good because sometimes you can tap into a great network that will offer you a lower cost of capital than if it was coming from strangers. It can be bad because the particular friends and family may not be bringing the level of judgment to this that they otherwise should. You've all heard of Theranos, and the seeds of Theranos came from friends and family. And it was particularly influential friends and family that were able to keep bringing unknowledgeable but very resource-heavy people into investing. So there's a lot to say about that. I don't want to get too deep into it, but it's friends and family can be, in certain cases, into pools of very large educated capital, particularly in those areas where sometimes you have families that are affected by a specific disease, and they may be unhappy with how much work is being done. If you have a project in that area, it probably pays to find out who's interested, because you may find that there are foundations, sometimes very, very well capitalized, that have an interest in putting money to work in an area you work in. Then we get to angel investing. Now, no, crowdfunding, put it in asterisk, put it off to the side. Yeah, I kind of simplistically put it. You had a question before. Okay, can you ask me that question?
Isn't pre-seed around as well?
Well, there's pre-seed, there's early pre-seed. These, when we start getting into these imprecise characterizations and categories, sometimes something becomes a pre-seed, even though they called it a seed when they raised it. When they decide they need to go out and raise another seed, I said, okay, it's like, you're actually not my first child, you're my pre-child. So it's I wouldn't get too hung up on, similarly, you hear about series A, B, C, and D in venture capital. Those have gotten wildly changed over the years. It used to be that if you're doing a course in venture capital, they say, okay, and A series is this much money, and B series, that's just got blown out of the water. That specific specificity is no longer there. Usually an A series is the one that comes after seed and before B. Unless you recapitalize the company, you go back to an A. So I wouldn't get too hung up on very specific definitions, more so the relationship between the categories. And before we talk about angel, the big difference between angel and venture is angel is individuals spending their own money. It used to be not that much money, and now you've got unbelievably wealthy people doing angel investing that are essentially doing the same checks that the venture capitalists do. Venture capital, like when I go out to raise venture capital, I'm going to high net worth individuals, family offices, institutions, investing in a fund. And then I in turn, I put some of my own money into it too. I in turn allocate that big pool of money to different companies. And that's venture capital because it's outside investors. If I was doing it just my own money, it would be angel investing. Okay, that's the big distinction there. Your question over here?
Yeah, I find often when you involve family and friends, they want to be involved in the process.
Yeah, that can be a complication.
So do you find any particular rhetoric or keep people in the loop with with emails, or I want to be respectful of people who invest, but at the same time, we don't want them to be governing something.
That's not only friends and family.
Right.
It's friends and family, angels, venture. You've
Right.
got it. You will set the tone
And helping them.
for the relationship you have with your investors. Some of them are going to be on your board. And frankly, some of your lead investors are, you have to look at some of your investors as your partners. It's for good reasons and for bad. Some of them are intrusive. In reality, most of them want to be value added. And one of the things you do when you choose your investors, if you have the luxury of having a choice, is you will choose investors that can help you hire people, that can make other introductions for you, that have a platform, or that have a name. If you bring in Andreessen Horowitz as an investor, they have a staff of people to aid and abet your operations. They have entrepreneurs in residence to help you out. They have, when you grow into the need of needing a CEO, when you become chief science officer or chief technical officer or chief operating officer, you need someone to oversee the financial part and the non-financial part. They have a list of candidates of really good people that have done it before, or if you need a CFO. So they can be fabulous partners. So they're, like anything else, confident yet humble, always keeping good investment, good relationship with your investors if you can. And I had an experience just yesterday. I was talking to a founder who was trying to politely get my feeling about a potential investor that had offered her a term sheet. And I don't do that. I try to avoid giving people opinions about other people, unless the person in question is so toxic that I'd be a horrible human being not to warn them. But you want to follow, part of the term. You want to follow the no asshole. You don't want to invite someone into your life who's going to be such a tax for the next decade of living that it's just not worth it. That said, those are the tiny tail of the bell curve of people. You'll find that. So there is a trade-off sometimes between them being passive investors. We all love passive investors. They write you a check, they walk away. You ask them a question, they answer, and that's that. But on the same hand, there's some tremendous value a lot of investors bring to you. Venture capital. Venture capital used to be one thing. The venture capitalists, I write big checks, I sit on your board, I help with subsequent rounds, and I plan to exit before my fund, before the expiration of my fund. Now, the venture capital world is really stratified. There's early stage venture capital. My first VC fund was pure seed stage. You've got an idea, let's make it tangible. And I had a very specific thesis that I was investing in. I went looking for specific ideas to solve specific problems. And I wanted to get in really, really early in order to have maximal input, just because I had a little domain expertise. And also, I wanted to, where are your best returns? Your best returns when you get in really early. If you're a high-level early investor in something that grows really well, you do Series A, and the valuation is 10 or 20 or $30 million. By Series C, you're at 500 million, and you're talking about going public in the billions. Well, you have to keep investing along the way to keep your pro rata percentage, but that's why venture does really well. You're not going to see something appreciate 20, 30, 40 times in 5 years on the public markets. It's pretty rare to find a stock that's going to do that. In the venture world, that's what they do. On the same hand, in the venture world, you got a real high probability of something to invest in going to zero. So it's a very different risk parameters that the venture capitalists have versus the later investors. Later investors like the people that typically the next step after venture is going public, if you need it. the size of the public markets, the amount of capital available to the stock, to selling stock, is much higher than the private markets. And I say that even within the past few years, the private markets have exploded. I'm going to give you some metrics to go on that. But when you quote unquote go public, and these are terms you all heard, some of you understand them, some of you don't really know what they mean. That's okay. And most people don't. Going public means that instead of selling pieces of your company in big chunks to individual, extremely knowledgeable investors privately, so that they can't turn around and sell it to somebody else. You know, it's like you bought it, you own it. You go, quote unquote, you go public. You cut your company up into millions of little pieces. You list it on a extremely efficient Craigslist called a stock market. And people can buy and sell it very, very easily for small amounts of money. That's going public versus, quote, being private. You go public from an IPO. An IPO is an initial public offering. This is where this class becomes fun, because some of you out there know more about this than I do. Some of you have heard these terms and never really knew what they meant. So I'm trying to like bring you all up to speed, the same common vocabulary. So you go public and you have, you've cut your company up into 40 million pieces. Each of those pieces is called a share. And you can buy a share of stock or whatever. Usually it's just a few bucks. The plus to going public is you have access to enormous pools of capital. You know, because people that can buy and sell companies, like my public fund, I could buy something on Monday, and if I decide I don't like it, this is not the way my investors want to think I'm going to invest, but I could if I want to. I get a new piece of news on Tuesday. I say, oh, that changes the story. I could sell it on Tuesday. You know, almost complete liquidity of your position. You do that in a private company, forget it. You're stuck with it until it goes public. The downside to being public is a much higher level of scrutiny that you have to undergo by the authorities. You know, the Securities and Exchange Commission has a goal, which is to protect the small investor, so that you can't, like in the private market, you know, I don't recommend lying to anybody. I mean, we're dedicated to being good business people, particularly in a science-based business, and particularly one that deals with human health. But it's also just bad business. But you can lie like crazy in the private markets, and there's a kind of the person you're transacting with, it's kind of on them to pick out what's true and what's not. You go into the public markets, you still have to answer to the higher authorities of the universe, as well as the dictates of being a good business person, as well as the dictates of being a good person, as well as the possibility, not very likely, that someone could turn around and sue you civilly for fraud, although it's not that simple in a lot of these cases. In the public markets, we have another layer of protection for the proverbial widows and orphans that could be taken in and buy your stock fraudulently. So you've got tons of regulatory requirements. You've got lots and lots of accounting requirements. You've got to publish every time you do something material so that everyone out in the marketplace hears about it at the same time. Something called Regulation FD, stands for fair disclosure. So the costs of being public are definitely not trivial, but it's something that most big companies eventually do. They list on the stock market. It used to be the New York Stock Exchange, now it's NASDAQ. You cut your company up into millions of pieces. You go public. You can later on do other offerings of stock. You could sell more pieces of your company, diluting out the ownership of the people out there, although they're more than welcome to keep buying stock. If I have a company that I love so much that I own 5% of it, I can go right back out of the stock market and buy more on 10%. When you cross 10%, the investor has more requirements in terms of disclosure. Same thing happens after 50, after 20. If an individual investor owns more than 50% of your company, then they have to include the profit and loss of that company in their own operations, accounting wise. So most of us will kind of stop short of 10% ownership. We'll stop short of 20% ownership. And once you're over 50, essentially you are the owner of the company. So you avoid that question.
So what's the benefit monetarily for a company to go public?
A bunch of reasons. One is it allows the owners to have some liquidity. Now, let's say you own, you're the founder of the company, and you own 20% of the company in a special preference, so you don't get diluted as new private investors come in. And your net worth is entirely the 20% you own of the company. You can raise money on the private markets at a valuation of $5 million or $50 million. Let's say. And your stake is worth 20% of that 50, about $10 million. And you can't do anything. You can't sell it. You get a salary, but a private company that's growing like this, the other owners don't want to pay tons of money in salary to someone that owns a big part of the company. You can borrow against it, but eventually you're going to maybe want to sell part of your stake, especially if that's all you have. So you go public, you as an owner with the proper amounts of disclosure can turn around and liquidate some of what you have. Secondly, the amount of capital that's available is just so much higher. Yeah, there's a lot of money that's allocated to public markets from pension funds and institutions. The Columbia University is sitting on billions and billions of dollars. It also is the second biggest landholder in New York City. So Columbia's got lots of money to do with lots of things. So they allocate a big chunk in the public markets. Why do they like the public markets? They like it because it's they get a daily mark. In other words, every day you can look up the price of your stock. And if they decide for whatever reason they need to sell it, for example, if pandemic comes along and they lose lots of tuition or something like that, and they need cash, they can do it. They can't do that with their private holdings, with their venture holdings, with their private equity holdings, things of that sort. So you go public through an IPO, you can raise money again through what's called secondaries. You can sell slices of a company called common stock, which is exactly what you said, common stock, piece of the company, piece of the earnings of the company, a piece of the assets of the company. There are things called preferred stock, which gives you preference in the case of liquidating the company. Let's say you have a company that's got a bunch of assets. The assets may include factories and land and tractors and stuff, and machines, all of which is a secondary market. Company goes out of business. You've got all this stuff, you sell it. Who gets the money from the sales? That goes to, depending on the structure of the capital, the cap table. If you have preferred stock, preferred shareholders, they get the proceeds of liquidation before the common shareholders do. Trade-off there is the common shareholders get to vote on the direction of the company. The preferred shareholders do not, unless the preference is written into the governance of the company. There's lots of complexity to it. There's also hybrids of ownership called convertibles, where you can take money that's lent to you that under certain provisions converts into common stock. So the cap table, which we talked about, remember we talked about balance sheet, what you own minus what you owe, and what's left is the owner's equity. That could be nothing but common shares. And in reality, most companies, most biotech companies, certainly, when they go public, everything becomes a common share. So every piece of that company is worth the same amount, has the same claim on assets, same claim on the cash flows, ultimately the profits, same claim on dividends if those are going to be given out. The more complex companies with layers of different ownership that's a level of corporate finance that we're really not going to get into. I could talk about it and bore the hell out of you for hours on the theory behind different levels of ownership. But we're on those hybrids. I want to escape from PowerPoint for a minute to see if we have a visitor. So far, no. Let's take a minute, just in case Dr. McMurray Heath is able to make it. In no way am I being critical of her. This is a person who's unbelievably busy, who's a phenomenal person. It just sounds like the scheduling didn't work out well. She was actually on the very short list of next FDA commissioner for a little while, although it looks like that's going to be somebody else. So a question here.
How does the company decide in how many pieces they want to break the company?
Mhm.
And how do they decide what the initial price would be?
You're getting into investment banking. The number of shares, there's two things you decide. First thing you decide is the number of shares you authorize. So we're going to, in theory, break the company down into X number of shares, 100 million shares. And that's decided by the, that's a decision in the initial corporate charter. That as it's changed, has to be ratified by the board and voted on by the shareholders. Now, the number you authorize is not the number that's actually out there, because you will issue a percentage of the authorized shares. And what you want to do is, like, typically, there's a pattern recognition here. In the United States, you go public typically with about 40, 50 million shares outstanding. And you add in increments. Share prices can be changed over time because you can split the number of shares, or you can reverse split the number of shares to get the stock price into a level that the market seems to be comfortable with. That doesn't happen in Europe. If you're listed in London, the share counts tend to grow very, very high. So there's a certain, really, the reality is it doesn't matter, because the number of shares times the share price gives you your value. The valuation is the key part of it. So as long as you've got a number that the marketplace can work with, then you're okay. Warren Buffett, who I quote a lot, only because he's very quotable. His company, Berkshire Hathaway, he never changes the number of shares. He always keeps it very low. So a share of an A share of Berkshire Hathaway is, I don't know, $50,000, $60,000. I never looked at, I haven't bought any Berkshire Hathaway in a long time, but it's tens of thousands of dollars, because he doesn't want to trade it very much. He wants people to buy it and hold it, which is fine if you're Warren Buffett. Most companies want a certain amount of volume of share trading, so they want the share price to be somewhat affordable. So it's, now this will change with inflation as well, but it's a certain, these are really banking considerations, and the bankers will, when they go out on the roadshow to do an IPO, they'll try to get a feel for what the market is. There's a couple of you, in spite of all my cautions, a couple of you have some investment banking experience, and even worse, some of you plan on going into investment banking. So you've got a little bit of experience on just how much of a process the investment banks go through to try to do proper price discovery and try to, quote unquote, fill the book with investors and get lead or, quote, anchor investors that they'll base the valuation on. And they'll undertake the transaction only if they think they can succeed in funding the company that well. The way the math works, the investment bank tends to get about 6% of the proceeds. So the incredibly friendly bankers from Goldman Sachs or Morgan Stanley or wherever are friendly because most of the time they're temperamentally very friendly people, and they're very good at what they do, and they seem to like what they do. But if they raise $100 million for you, they get $6 million at the end of however many weeks or months work. So it behooves them to do what they do well. Yeah, they're incentivized to make the deal work. So it's a, the process, it's a process that often works. Question about it.
Just a question on like, is it frowned upon to like, release like costs of shares?
I'm sorry, could you say a little louder? The
Is
door
it
was
frowned
shutting.
upon- Is it frowned upon to release different classes of shares that don't have voting power? Like when you're doing an IPO?
You
I know
know,
like Google has like class A, class B
it
shares.
depends on what you're solving for.
Okay.
And what the nature of the company is. Google is not going to go out and raise money. They don't need to. Google funds itself by retained earnings. It makes so much money that there's really no reason for Google to go out and sell a piece of itself. If anything, Google may have the incentive to buy some shares back. Say it's like, we know Google's finances in the future better than anybody else. The marketplace is placing the value of 1/100 millionth of Google's company at X. We think it's worth 3X. So we're going to use some of the money in our treasury to go out into the market and with proper disclosure, buy that stock back. Because it's the best use of our cash at hand. What do you do when you start making money, which is kind of far away from early biotechs? Once you start making money, there's a limited number of choices you have as to what to do with it. You could buy your shares back, you can dividend it out to your shareholders, or you could invest it back into the business. Google does a tremendous amount of investing back in the business. They don't pay dividends because frankly, the tax treatment for dividends for the holders is not that good. That's ordinary income and gets taxed at ordinary income levels, which is high. So dividends, which used to be the primary way that people profited by owning shares, is really got shunted off to the side, except for a certain type of company, like utilities, with a very transparent, easily defined cash flows. Listen, utility companies are not going to grow that much. Most companies you want to own stock and you want to buy for growth. So Google, they could do whatever the heck they want with their cap structure. You'll find, and when we get more into accounting later on, when you look at the cap structure of the company, you say okay, different levels of the way they finance the company. You look at what was borrowed, what was financed by selling pieces of the company, and what the company owns. You may find that there's a very nuanced, thoughtful, and rational way they went about financing the company. Matching up the financing vehicle with the duration of the asset in ways that minimize cost of capital and maximize the amount of cash you hang on to at any given time. Or you may find that there are lines in the cap structure that stick out like a sore thumb that really don't make a lot of sense. And if you dig down, you may find that there was a owner of the shares or someone who came into the company that dictated extremely favorable terms for their ownership. And then either the company was in not a good place to negotiate, or they just weren't sophisticated enough to realize. So there's a lot of things you can learn from the cap structure. So is it looked down upon or frowned upon to have a preference level A, preference level B, preference level C? It's got to be taken within the context of the overall capital structure of the company. So again, go back to your balance sheet and what it tells you. It tells you what you owned and it tells you how you paid for it. Left side of the balance sheet, right side of the balance sheet. So you look at that, what's the reason for those sub-levels of preferred ownership? Maybe lots of good reasons. It may be really good corporate finance, or it may be bad bargaining, bad planning, bad strategy, or just being in a place where you had no other place to go to finance your company. Okay? A real long-winded answer. Okay, it looks like you guys are stuck with just me today. Okay, so let me go back to putting this back up. And let's talk about where this money comes from. All right. Now, you guys are all within academia. So the same way being in biotechnology in the 21st century means the forefront of your mind is the genome and DNA and genetics. You live in academia, which means the forefront of your mind for financing is the NIH. Okay? You all think about it, it's the cornerstone of academic careers. And if you look at historical NIH funding, the NIH is the single biggest funder of basic science and certainly applied science within health in the world. There are tremendous amounts of money. You look at the current dollars, 39 billion was this year's allocation for funding. Next year it goes up to 42 billion. There's always a political fight, and yet it always gets funded. It's very easy to grandstand on, oh, we're funding this, bunch of scientists, what are they doing? In reality, they're doing really important work. That's $42 billion, which is, adjusted for inflation, it's been pretty constant. It's frankly, it should be a little bit higher. Our bias, both being academics and science-based academics, it'll never be high enough for us. But it's a lot of money, and it's always important. It's the earliest, most difficult to fund stuff. They're funding the stuff that's furthest away from being a product. The stuff that you can't possibly put a value on. And it's their job. They fund basic science. They're not funding things with an eye to the commercialability. However, they are funding them with an eye towards what's going to solve problems. And certainly that's their job. Now you compare that to the funding that comes out of the private sector. Now this is an old slide, which I'm putting up intentionally. I started teaching this class back in 2011. And this is a slide that comes out of Ernst & Young put it together. And it's Europe and North America only, add another 20 to 40% for worldwide, depending on the year. So when I was teaching this class, first year, total funding out of the private sector was about $33 billion in North America and Europe. 2013, it was about, the NIH was doing about $30 billion, about equal. So important contribution from the public sector, important contribution from the private sector. Okay, so that goes up to 2011, started growing. As you can see, in the private side, fits and starts. When I first got into this business in 2004, close to the same at 20 billion, grew some years better than others, gets the Great Recession, got cut back. This was what we called the Valley of Death. I was doing biotech investing for about 3 years at that point. And at that point, leaving medicine to become involved in science-based investing seemed like a really bad idea in 2008. Thankfully, that subsequently reversed. Now, keep this number in mind, about 30 billion, about the NIH around then, and about the private markets around then. Fast forward to now. Now, this is global. So this includes that extra 20, 30% from the rest of the world back in 2013. That number's been growing. Look where we are now. We're looking at $250 billion versus the 42 billion that we talked about that's budgeted in the US federal government for this next year. So we have gone from close to equal footing with the NIH to 7-8 times what the NIH is doing, coming out of the public markets. Now, some of it is, you can see it's all the different types of things we talked about within that funding cycle. This is coming from everywhere. But this doesn't happen by accident. It happens from a couple of things. One is the productivity of the biotechnology industry. We've gotten better at converting ideas to tangible benefit than we used to. We've become more efficient. The other thing that we've done is we've gotten better at finding ways to fund this. When I started doing this back in 2005, I had an MD back. And the bankers thought that was really cool. As someone with a fundamental background layered on top of the finance background that most finance happened. It was kind of dual lingual. There were a small number of specialty healthcare and biotech focused investment funds, usually on the venture side, limited to venture. Fast forward to now, there is tons of them. They're stocked with MDs and PhDs, people that have jumped back and forth between investing and academia, people much more grounded in basic science than I will ever be. I was the typical med school. I took my pre-med stuff. I did my first year and a half in the laboratory and classroom, and then they unleashed me on human beings. So I've done my best to stay up on the science, but you go to some of these large investment firms, they do venture, they do public, it's called a new area called crossover, where they will do a late stage venture round. The plan will include putting money away for the going public transaction as well. So we've become a much more efficient funding industry on top of it. So you've got this growth, a better opportunity, attracting bigger pools of capital, specialization within the biotech funding sphere. So if you're developing something good, there's a lot more money out there looking for it. And they're looking at it in a much more sophisticated way. We said earlier that in order to get yourself funded, you've got to have a great idea, but you've got to have people that recognize it's a great idea. You got to have people that are going to be comfortable that they can de-risk the long development period by asking you a million questions about what you know, how you're going to go about bringing these value inflections. So it's like, you take your car and you stick it on the lawn with a for sale sign. And some people will walk up and say, gee, I like the color. And it looks really cool and it's real clean. And that's the base of buying your car. And then the next, group of people come up and they pop the hood and they start taking the engine apart. And they take the tires off and they put it up on a lift. And I don't know that much about cars. It's a very different vetting process. That's what we have in biotech. So there's we are flush with capital relative to where we were before. Now, that's a great thing for this industry. And it's really kind of grown up with the industry. Great time for you guys to be going into the industry. Do not think though that 2008 can't happen. In 2000, I believe, there was a joint press conference by Tony Blair and Bill Clinton when they were talking about the genome, which was hadn't been published, but it was on the way. And there was this offhand comment made during that press conference about, well, the genome should really be a public good, and it should really be open sourced, and anything that come out of it really, just some kind of implying that there should not be a free market that comes out of this. Boy, the market tanked for a year or two. There's all sorts of things that can really kill a market quickly. It's gene therapy in the late 1990s. They had a very unexpected tragic death in an early stage trial. Gene therapy literally took a decade before it recovered from that. So it's good to put these boom times in perspective. A couple questions. You've been so patient.
Yeah. So one of the questions I had is, you see like the spike in 2019 and 2020, which is probably infectious diseases. And I guess kind of going back to like the podcast that you sent out, the guy talks about how there's like, in the midst of pandemics, you get these inflows of people, running to infectious diseases, you get cash, talent, and then afterwards they all disperse. Like there's really no care for preventing infectious disease.
Oh yeah. Yeah, virology and vaccines are one of the toughest areas to make business.
So
Make money in.
with that in mind, as hopefully we're moving out of this pandemic, do you see that funding transitions into other projects? Do you just see an overall kind of, recession and how much we start putting towards biotech?
Well, there's a couple different areas to unpack within that question. One of them is, vaccines will always be the purview of public health. For all the libertarian talk about how the private sector is more efficient, there comes a scale that the private sector cannot scale up to, that you need a public sector. Just the nature of the potential profitability, the period, the infrequency of it coming along. There's some things that, for better or for worse, regardless of your political inclination, have to be done on a population-wide scale. National defense is one, lots of public health is another. So, the issue of preventive, vaccines from preventive sense, how far are we from the next pandemic? Good question. It's the pandemic preparedness, a tremendous amount of time and effort went into pandemic preparedness in 2 administrations ago. And then it got lost and de-emphasized. So as far as that aspect of it, I think that will again become backburnered and will become something that becomes a part of the political process, the political funding process. Hopefully our memories are not so poor that we forget about it, because certainly nature hasn't changed and viruses remain as efficient as ever mutating, ever efficient. Last week when I wrote at the bottom of the list, biology always wins. You don't have to go too far to figure out what a virus is going to do. And we know there is a background noise of virus ecosystem that will continue doing what they're doing. Now, to broaden your question, vaccines in general have much more to do than just kill viruses. We are mobilizing vaccines to do, Chip Clark, our first speaker, he's working on it, for cancer, mobilizing that obscenely complex and powerful human immunology to work against other unwanted, occupants of our bodies. So in that sense, it's going to be, that's part of a longer term movement towards vaccinology and away from just virology. Similarly, mRNA, like we talked about last week, as we started going, you go from a circulating protein level, cell surface level, a cytoplasmic level, then into the nucleus. mRNA is going to be mobilized in ways that we just didn't have the capability of doing. So you think you got a little company like Moderna, which was, kind of puttering along, doing really good science for a long time. And then the bonanza for them of COVID comes in. And they are exceptionally well capitalized. They've got tremendous amount of IP on all aspects of mRNA therapeutics. Plus, you've got a whole bunch of other companies that have been able to get funded because we're seeing the value of this. So again, my typical long-winded answer to a straightforward question. Lots of different ways that this is going to reverberate in the near future, independent of just the efforts we're going to put into preventing the next pandemic. Question?
Do you think that the effort now in terms of virology vaccines should move away from prophylaxis and move towards like antiviral medicines because viruses mutate so heavily?
Yeah, I don't think they're mutually exclusive. I think you should really do them both. Certainly you want to keep people from getting sick, and the people that get sick, you want to be able to cure. So, it just turns out that, depending on the virus, these are tough actors. And the problem is, as we know with all viruses, is they just keep changing. There's a reason I get a flu vaccine. This year, you guys all should too. That's the doctor in me talking. But there's no reason why we can't go after both. And, these decisions will be made at a policy level within the, within the NIH, with the FDA, with the CDC. The investors and the companies will also triage their time and their dollars based on the extent to which they can model out these future needs. And the problem with relying on investors to do this is there's a second order aspect of these decisions. The toughest thing that I do, especially for my public fund, is not figuring out if something's worth a lot. It's figuring out how other people will assess that work. And that's, for you get a bunch of science and medically trained people that go into investment world, and everything is pretty linear between the inputs that go into the decision and the decision. And we figure out how to put a value on something. Problem then becomes the perception of that value by others. Because you unleash something into the stock market, and the market's going to do what the market does. And the market can be very irrationally irrational. And that makes us rational people, makes us crazy. So particularly, it's most, that plays in best with like the Warren Buffett's of the world. Because the way he looks at it, he's always termed it. In the short term, the market is a voting machine. In the long term, it's a weighing machine. That the weight is what the weight is, not what people perceive the weight. In the short term, it's what people perceive the value is. In the long term, it's what the real value is. These companies that are all pre-revenue, some are going to blow up and they'll never make $1. Others will make tremendous amounts of money as they get closer to making money, as they go to phase 3 trials and generate data. And you can put a higher level of confidence on the models that you put together, projecting how much money these companies are going to make. Then it becomes more of a weighing machine. Then it becomes more of a rational math problem. The further distance you get from this, it becomes a combination of taking all those rational inputs and then a little bit of luck, a little bit of market research and knowledge, and trying to figure out what the overall market's done. And then that could all get blown out of the water by a big thing like COVID coming along, and the entire investment marketplace changes. This year, just parenthetically, in the public markets, the biotech stocks have been terrible. It's been an awful year to invest in biotech unless you invest in biotech. And even there, some of them did spectacularly, some of them did poorly. And then there's a little artifact of a single drug getting approved for Alzheimer's, and suddenly all the neuroscience stocks did really well. But that's kind of like robotic market type stuff, which is background noise. Anyway, question.
Looking at these graphs, how much more room do you think there is to grow for the private versus like when you say that 30 billion is almost like the cap for the NIH? Like, can this go and can the private surpass?
I'm not going to try to find what the NIH is, what they're going to do, because that's a political process, which is that's filled with divide by zero errors. So you're trying to predict the political process, forget that.
Okay.
As far as the marketplace has no bounds. The pools of capital are just so unbelievably big, not only in the stock market, but in private equity. The amount of money that a company like Norway is sitting on because of its oil reserves that gets allocated to various things within the investment pool. This $250 billion that went into development stage biotech is the tiniest drop in the bucket of the overall investable capital in the world. So a series of headlines, a series of shifts in emphasis by a few big decision makers, and suddenly the amount allocated to this 250 could be 750. So it's very, I would be very foolish to even think that I could answer the question intelligently. 2013, let's go back, you guys are like in grade school, and I'm teaching this class, and someone points to that 30 billion. They say, well, what do you think it's going to be in 2011? If I said, 50, 60, people would think I was being crazy. And here it is, 250. 8 years later. Question back.
So what sort of, when you get funding from the end, what sort of strings are attached to it?
Yeah, that's a really good question. I've never had an NIH grant. There are probably a bunch of people in this classroom that could probably answer that question better than I do. I believe, yeah, the grant applications are like encyclopedic, including use of funds down to buying petri dishes. So it's really, I believe, anyway, somebody correct me if I'm wrong, that there's an extremely granular budget you've got to give them. Use of funds, I think they're pretty good at, and the NIH doesn't take ownership. So one of the big political things is, oh, we pay you, NIH pays for basic research, and then these companies go out and make billions of dollars from it. Well, it is what it is. You know, the NIH is not a funding body, it's not a hedge fund, it's not a venture capital fund. And frankly, we don't want it to be, because we do want to fund basic science at a use agnostic level. You know, no one knew that CRISPR would be as valuable as CRISPR was back when we were studying it as a means by which bacteria protect themselves from viruses. You know, we had no clue that within 8 years it's going to have companies with market caps in the multi-billions of dollars, whole lot of them. Like you just said, you just don't want to triage your earliest stage basic science capital with an eye towards a return. Anyway, so that's my non-answer to your question.
Well, just to put more clarity on that.
Yeah.
There are different funding mechanisms from the NIH, so depending on which route you go, the structure is broken down. So R01 are super competitive because the PI or the entity that's applying for the R01 gets the most money, but other grants, a lot of the money goes to the institution, like Columbia University, to keep the lights on, to run all this stuff.
Okay. I will try to remember that. Yeah, that's really, I've got to admit that NIH funding, other than aggregate numbers and things of that sort, is a complete black hole in my experience. So I've been very little to. So you get credit for teaching a few minutes to pass it. Question.
I'm curious, what you were saying about perception and its effects on the public market. I know that partially thinking back to the podcast that I was about like the political of like general data availability and thinking about like how that sort of impact translates to the market, which I'm pretty sure is like quite profound. So how does like all of the political and like oscillations in a really outspoken and like people who have a lot of influence but may not have the knowledge to back up the things that they're saying, how does that sort of impact the market and how does it like find its way to like center around the oscillations?
Yeah, it's a very good question. And if you have a specific person in mind whose influence you're thinking of, or
Not really. I think it's just like especially thinking about the political climate and just in the past 10 years if you take like that.
I get it. Yeah, there's two aspects to it. The long-term value in a platonic sense, number of people you're helping, how much you're willing to be spent to get that help, and the true flow of economic activity that comes from something. And then there's the market perception of what that is in the short term. Now, I cannot emphasize how much noise is in not only the public markets, but the private markets as well. Like there is plenty of en masse movement within extremely smart late stage venture capital firms where they all do the same thing for a while, and then they all realize at the same time it doesn't work. But the stock market is probably the best example of that. You will see these movements, sometimes lasting only a day or two, where a specific headline will catalyze a specific chain of beliefs, which may find a means of amplification, whether it's CNBC whether it's Twitter, it's whatever, or whether it's a given broker planting this idea and all their salespeople say, call everybody. And it gets picked up, and there's a scuttlebutt network within the investing community, the professional investing community, where we all have these chat boards on our screens through Bloomberg, and someone said this and this analyst said that, and suddenly this particularly obscure and not necessarily very fact-based opinion has been amplified so widely that, and then it goes into the, okay, how are the other people in the marketplace perceiving this? And there are times when I get, something will cross my screen and I know it's not true. Yet I know or I suspect the market will just place an absurd amount of emphasis on it. And sure, you just sit back and just see these individual stocks doing this stuff. And there are people that are traders on the public markets that are very good at perceiving these short-term movements. The important thing to know is these are short-term movements. Now, there is a long-term value is value. Now, in the meantime, long-term we're all going to be dead. But in the meantime, a lot of projects will get overfunded because it's hot, or will die because no one cares about that specific area. I realize I'm answering your question in a very vague sense. Just the best way to put it is there is a tremendous amount of noise in the marketplace that different actors will see through in different ways. And but yeah, tremendous amounts of inefficiency and capital allocation because of it.
Not all of those impacts are necessary for short term, or you think that there's possibility for some of those like stronger opinions to create more long-term impact.
Well, yeah, ultimately, like playing poker, you got to put your cards on the table. So we're not gonna continue to fund completely unproductive areas, whether it's an individual company, whether it's a platform, whether it's a sector or segment, or a piece of technology, if it never makes any money. Now, the one thing that we can be sure of in the public markets is everybody's trying to put their money to work to do lots of things, but mainly to make more money. So short term will vary from a day to maybe several years. And ultimately things will change it. But for example, it's extremely difficult to fund antibacterial drugs. It's very difficult to fund anything that cures a disease quickly. It's ironic because the societal value is so high. But for the same reason, it's difficult to get funding to prevent a disease. It's much more profitable to cure something or to treat it long term. And it's really more profitable to treat it very long term. So it's, there's definitely a misplaced incentive there. And our pricing mechanism, our distribution mechanism for medical care beyond just drugs is so inefficient that we end up reinforcing a lot of the worst stuff rather than the best stuff. But again, I'm broadening the scope of your question. Other questions? Now, I try not to talk about investing very much from the investment standpoint, but I do write a lot about it. So one of the reasons I started writing about it is so that people would stop asking about it in class. So there's a lot of, I tend to write the same article again and again and again. So if you read it once, you probably know everything I know, but the stuff is out there. So we talked about the 250 billion, that's all in the investing. The venture capital alone is almost up to what the entire investing world was back in 2013. So venture capital is and it's expanding wildly. Mainly, it's a virtuous circle. As the returns are good, the big asset allocators allocate more to venture capital. When the venture capital returns within biotech tend to be better than the venture capital returns in tech or other areas of venture capital, then more of it tends to go there. So you're seeing this is rising. Is some of this potentially a COVID effect? We won't really know. It could be. And similarly, the number of companies that have gone public, this is the post-venture. You might say, well, if we've gone from 30 billion to 250 billion, how come a lot more of it is in venture? Because venture is so disproportionately involved in biotech. One of the reasons is it's been so much easier to get these companies public. The same thing, we're more productive, we've got ease of funding, and the returns have been good. A lot of companies have done very well. That's made it easier for the bankers to take a earlier stage private company and take them public. And that's a combination of broader diversification of ownership, easier liquidity for the original holders, as well as the fact that's where the bankers make their money. There has been over the past few years a shift away from projects that traditionally would have been venture-based and continue to be venture-based are now entering the public markets. You've got a lot of companies that are called platform companies that are far, far away from having a drug, even a drug in trials, much less a drug that's being sold. So there's been this kind of movement within the industry out of venture and into public, as well as the fact that the venture has multiplied as well. Are we reaching an asymptote here? Are we reaching a limit? If you want to be right eventually, get into the financial markets and every 6 months say it's becoming a bubble and just keep saying forever, eventually it will. And people say, you predicted it. It's like predicting a recession. They say that X is so good, he or she predicted 10 of the last 1 recessions. It's the same thing with predicting an asset bubble. The flows of capital are an extremely complex ecosystem. And as much as we want to take AI and machine learning and use it to predict where the money's going, it's the ultimate, what happened in the past doesn't tell us what's going to happen in the future. And you can apply machine learning to weather patterns. You can apply AI to internal body systems. And there's a steady state functioning there. The financial markets and where risk capital goes is always changing. And the change is very much programmed by what went before it. So this will always be unpredictably unpredictable. That's one of the reasons why it's fun. Okay, so here's the, again, just saying what's gone on globally, the amount of IPO funding. This is the specific transactions, taking things out of the venture world and into the public markets. So obviously this has gone up a lot. So we've got a couple more minutes. Let me take the last few questions. Maybe we'll get into part 2 of why biotech is hard. Maybe we won't. It's down. Okay, questions in the back. Haven't heard from you.
Going back to that active slide where it saw the increase in I thought it was interesting that you don't see that with Europe. It's kind of a declining effect.
Yeah.
Do you know why that's the case?
Well, part of it is, I don't know much about the institutional temperament of European-based institutional investors. I do know that Europe tends to be, there's a whole political means by which Europe invests. There is we took it to go into corporate governance for a moment. In the United States, the fiduciary duty, we talked about this briefly, we talked about benefit corporations. The fiduciary duty of the board of directors and management of companies, the owners of the company, to hell with the rest of the world. You go to Europe, the fiduciary duty of the board of directors of a company includes the workers, includes the population, includes the climate. It's a much more broad-based means by which they make these decisions. Similarly, the regulation of buying and selling of companies, the disclosure is much greater. It's not as easy to get in and out of companies. There's kind of a, I'm trying to find the right word, whether it's democratized, whether there's a kind of a political means by which they make these decisions. Now, I'm speculating that that may carry over into the way these institutional decisions are made. Within the whole universe of places where big allocators of capital can put their money, biotech will always be amongst the most risky. So whether it's a difference in risk tolerance or a difference in just the nature of the industries in Europe, realize you don't get the enormous prices for drugs in Europe that we get here. So, it's obviously a big political issue over how much we, whether we subsidize the rest of the world with drug prices, who knows? That's beyond the scope of this course. But all of these things tend to make Europe's approach to this particular industry possibly much more conservative. So that's my best guess. I wouldn't take it to the bank. And if anybody comes up with a much better, or more importantly, data-based reason for that, I defer to that. Other questions?
I don't know if this happens much, but do you ever appreciate as an investor if somebody who's creating a startup is also creating simultaneously with their startup some form of cash flow? Like a lot of times I think about my potential company. I think a lot of people in my company could be consultants.
Way too vague a question.
Okay.
Really depends on the company, depends on what they're developing. Is the cash flow an unnecessary diversion of their time and effort? Where they should really be focused on what may be a much better thing to do? Or is the cash flow something that should be the business? We just don't know. Or are they really synergistic? Should they be broken in half and hire somebody else to run one, hire you to run the other?
But there are different models.
It's really, depends on the specifics of the project. You could make a case for being a good idea, you can make a case for it not. It depends on the specifics. Question?
Yeah, so I know we're running short on time. You had mentioned that there's like an incentive for treating treating diseases over a longer period of time versus a shorter one. And a lot of the genes out there is a really high price tags, which tax like
So one is done.
insurances.
Yeah.
Yeah, so I'm curious what your 2 cents is on like how insurance might try to adapt.
Yeah, it's a tough one because the US, and if we go over time, maybe it has to leave. Go ahead, just be quiet as you do. The problem is, like I've been trying to work on this on the preventive side of reproductive medicine, using in vitro fertilization and genetic analysis of embryos to prevent monogenic diseases in families that are losing children. And the pushback I keep getting from insurance is that one insurance company doesn't want to pay for something that's going to end up saving another insurance company money. It's such short-term, poor thinking. So you take that, like the insurance companies, I don't know how insurance companies think other than they worship at the gospel of actuarial things, which is fine. That's what insurance companies do. That is their DNA. So projecting market sizes is very difficult. Projecting what the reimbursement is going to be tends to be really difficult. So gene therapy, which came from a pure basis, turns out that may not be true. So far, the initial gene therapies seem to slow progression or severity. They're not the cures yet. Hopefully they will be. That was, okay, let's do the economic modeling, let's do the econometric modeling, let's figure out the healthcare benefit to the system and work off that. So if we prevent a lifelong treatment for cystic fibrosis, discount it back to now, that's in the millions of dollars. Same thing for sickle cell anemia, same thing for all these drugs. Now we're going to cure, and right now we're making, Vertex is making 300,000 plus per year per cystic fibrosis patient. It's on some of their drugs, at least that's the list price. They're going to say, fine, yeah, we'll give that all up. We'll come up with a gene therapy, but we want something that's, giving us the same healthcare benefit for the drug you guys are already paying for. So it's going to get these price tags in the millions for a single shot. So that's kind of where the thinking is. The difficulty I find in my own little world is there's already a price tag on an IVF cycle using genetic analysis of the embryos. It's about $25,000. So it's anything. I was like, I'll get on Twitter and I'll talk about this. There's always someone from the pharmaceutical industry telling me, yeah, but not all diseases are threatening. They try to break my argument down because it's a threat to the business model. In my mind, there's room for all of these approaches to coexist. But the small molecule, inexpensive one and done treatment, antibiotics, the economics just aren't there because the same cost of a clinical trial, the same cost of an NDA or a BLA through the FDA, which is in the hundreds of millions of dollars, you got to pay that no matter what. So the cost of entry into having a drug is a ton of money. It could be 10 times the same ton of the money, but it's always a ton of money just to get in the game. If it's to get a drug that you use once, that you'll be negotiating a price, maybe it's 1,000, maybe it's 10,000, maybe it's 50,000, depending on the severity of what you're treating. And some of these nasty antibiotic aimed drug diseases are terrible. You take the drug for 10 days, it's gone. It's a miracle of modern medicine, but all the economic incentive is wrong. So it's something you have to deal with. Something you guys are especially going to deal with, because the trends this is unsustainable. The difference in affordability of basic health care in this country versus other countries. Anyway, that's another lecture. We're way past time. I'm happy to stick around if you have questions, but you're not being impolite if you have to get to the next thing. We'll see you all next week. Let me turn off the Zoom link.